Okay, so today I have 6 or 7 popular tax write-offs that many people take, but if they're not careful, it can land them in trouble with the IRS, because once people fall in love with saving on taxes, then there's really no limit to what people will try to write off for the sake of their business.
That's a write-off?
Yeah.
Do you even know what a write-off is?
Yeah.
But at some point, you have to draw the line and realize there is a right way and a wrong way to legally take an expense as a tax write-off. So in this video, what we're gonna do is take a look at why some tax write-offs get you in trouble with the IRS. We'll look at 7 tax write-offs that you need to be careful with. And then lastly, we'll share some tips to help you stay out of trouble with the IRS. So if all that sounds good to you, then please lend us a helping hand by liking this video while the intro plays. Hey there, and welcome to our channel. I'm Sean with Life Accounting, the accounting company that helps you save on taxes and build more wealth. And if all that sounds good to you, then hey, what's that in the sky? Okay, also you should know that I put the timestamps down in the description below and in the play area so that you can skip to the parts that you want to learn the most about. Okay, let's dive in by looking at some big reasons why some tax write-offs can get you in trouble with the IRS, starting with number 1, exaggeration. So one of the requirements for taking an expense as a tax write-off is that it must be an ordinary expense, which means that it is commonly acceptable in your industry or line of work. And exaggerating these expenses can get you in trouble regardless of what expense you are writing off, because, okay, if you're writing things off simply for the sake of saving on taxes, then it's going to be obvious.
I'm thinking of bringing homeware into the store, so that's a write-off.
Now, a good rule of thumb to keep in mind is that any tax write-offs that you take that are disproportionate to your level of income can sometimes raise a red flag. For example, if you made $1,000 in income, but then you reported a $20,000 tax deduction in something like wages, then that could be a little bit unusual, right? Because exactly what requires you to spend so much money yet earn so little income? Now, of course, when you are in the startup phase and you have a new business, then that's completely normal. But it does become a little bit more sketchy when you are taking huge tax deductions year after year, or you're running a business loss for multiple tax years. The next big thing that gets people in trouble with the IRS is number 2, the expense is not necessary. So on top of the fact that a business expense must be ordinary, it also must be necessary for your business to take. For example, it may be necessary for your business to have a few computers and monitors so that you can get work done efficiently. However, if you were to spend $25,000 on 15 computers, then you better have a good reason for that expense to be necessary. Like maybe you own a computer store that sells laptops. Well, in that case, it would make sense. That would be ordinary and necessary for your business. But if you own something like a laundromat and then you go out and you spend $25,000 on computers, well, of course, that would be sketch.
So if I need booze to get through my day, I can just write that off?
That's a stretch.
Okay, moving on to the third thing that can get you in trouble with the IRS. Number 3, misreporting. Now, this one gets people in big trouble, because if you misreport things like your income or your expenses, then you can get investigated for tax fraud or tax evasion, which can land you in jail. So listen, I don't care if you owe the IRS $1 million, okay? You never want to misreport things that actually did or did not happen. Instead, you should always seek legal ways to reduce your tax burden, right? Like there are hundreds of different tax strategies that you can deploy and paths that you can take that legally reduces your taxable income. Which, by the way, if you need help with tax planning, then we may be able to help you out. Please check out the first link down in the description below. All right, now let's go ahead and jump into some specific tax write-offs you need to be careful with taking, starting with number 1, travel expenses. So if you love to travel out of state, then writing off stuff like airfare and lodging and transportation may seem like a good idea. And of course, if you want to write off any direct travel expenses, well, first of all, you need to be self-employed and traveling for a business purpose, okay? But that doesn't mean that you can just book a trip to Cancun and hand out business cards and call it a business trip, because
That's not a write-off. That's not a write-off.
Instead, your business trip should have a purpose planned before you leave for that business trip. The purpose of business travel may be stuff like searching for a new office space, or having your annual company retreat or board meeting, or meeting with potential or current clients, or if you're going to a conference or an event to help you grow your business. So before you leave, you should have an agenda, right? Like you should have your meeting set up, you should have appointments booked, you should have already bought your conference tickets, and so on. And you also want to keep proper documentation of the trip, which means that you're keeping stuff like your conference tickets or your transportation invoices and your meal receipts. Now, one of the things that you can do to keep track of all these expenses is to grab an envelope from your hotel and then put all your receipts from your trip inside of that envelope. And then you would label that envelope with a name and a date to help you remember, as well as the IRS remember, that business trip. Because without proper documentation in place, you could get some questions from the IRS. Okay, moving along to number 2, I have cell phone expenses. In 2022, almost everyone uses their cell phone for business. Whether you are talking to a client or talking to an employee or texting with a vendor, the cell phone is nearly essential for business. The gray area with the cell phone expense is that most people use their phone for both business and personal use. So what I like to do is allocate the percentage used for business and then write off only that portion, because as long as you are on the job and using your phone for work, then you can take a look at taking your total cell phone expenses, the service and the device costs, and then take a percentage of that as a tax write-off. For example, let's say that my cell phone bill was $100 a month, and I estimate that 75% of the phone was being used for business and 25% of the phone was being used for personal uses. Well, I could write off that $75 a month or that $900 annual expense as a cell phone expense. Now, of course, if you know you did not use your phone majority for business and you still try to write off the full amount of your cell phone expenses, then that can land you in some trouble with the IRS. Okay, let's go ahead and keep on moving along with tax write-off number 3, the home office deduction. The home office deduction used to be a major trigger for audits, but in 2022, the IRS knows that more and more people are working from home, including self-employed business owners. So nowadays, there are 2 big things that people mess up when it comes to taking the home office deduction. Okay, number 1 is not having a dedicated home office, because having a dedicated space for your home office is a requirement, guys. Okay, you can't just add a desk to your living room and then call that your office.
That's not a write-off. This? Not a write-off.
Ideally, you want an area of your home that is dedicated to your office. Think something like a spare bedroom or a garage or a basement or a den. Okay, a space in your home that is not being used for anything else other than your home office. The second big thing that people get in trouble with the home office is exaggerating the square footage of the office space. Now, of course, if you have a floor plan or you have a professional who can get you measurements of your home office space, then the IRS will prefer that. But if you have to estimate, then I would estimate on the lower end and not on the high end, because the last thing you want to do is have the IRS bust inside your home and find out that the measurements are completely off. Freeze! It's the IRS! Okay, that's just a joke. But again, to summarize this one, make sure you have a dedicated office space for your home and you don't exaggerate the size of it. The next tax write-off you want to be careful with is number 4, family salaries and wages. So if you are employing a spouse or employing a child or a close relative, then it is very important not to give them extra special treatment. Ideally, you should only pay your family the same amount of salary that you would pay someone else for doing the same job in that same position. And you want to make sure that the job responsibilities align with that particular person's age and experience. For example, if you are hiring a child who may be 14 years old, it may seem a little bit sketch to pay them an $80,000 salary just to organize your files. And listen, paying your children can be a great strategy to save on taxes and transfer income, but it still needs to be ordinary and necessary for your business to do so. Okay, the next tax write-off to be careful with is number 5, personal expenses. Okay, it may be obvious by now if you're paying close attention to this video, but if not, let me make it super clear. Okay, you simply cannot deduct services of purely personal nature on your business tax return or any schedules that are not related to your business. For example, you cannot deduct stuff like landscaping or snow plowing simply because you work out of your home office. However, if that was a rental property, then that would likely be able to be written off because those can be classified as business expenses. Now, the next tax write-off you need to be careful with is writing off your dog. Now, believe it or not, writing off your dog can be a legitimate tax write-off. That's right, as long as your dog qualifies as your company's guard dog. Now, that doesn't mean you can just have your dog in your house guarding your home office, right? Like, it's not that simple for two big reasons. Reason number one, your dog must be guarding something precious like your business inventory, and it must be around that area pretty consistently. And number two, you can only write off the portions of the dog's time which is being devoted to being on guard dog duty. So that's another interesting tax write-off that you can take, but you must be careful with it. Okay, tax write-off number 7 are clothing expenses. This one tends to trip up many people because the tax rules around writing off your clothing seem to be a little bit gray. For the most part, the IRS says that if you can wear clothing outside of your work, then you shouldn't write it off. For example, a new business suit wouldn't qualify since you can wear that suit to other places outside of your work environment. But then again, what about clothes with your logo on it or clothes that you only wear for specific business reasons like your YouTube videos? Well, that's when things appear to be a little bit gray, right? Now, I have an entire video breaking down how to write off your clothes legally, which you can check out after you finish this one. Wow, okay, since you made it this far in the video, I have 2 more bonus tips for you, starting with bonus tip number 1. File your taxes. Okay, I get it, right? Hardly anyone gets super excited about filing their taxes, especially when they know they likely owe money. And almost every tax season, I run into business owners who have failed to file their taxes for multiple years. Everything's okay, nothing to see here. But listen, it's better to file your tax return than to put your head in the sand, especially if you don't want to get in trouble with the IRS and have them questioning all your tax write-offs, because once you're found not to be compliant, then audit triggers really start to go off and all your business income and all your business expenses come under scrutiny. It's almost like you're inviting the IRS into your business home. So the tip here is to pucker up and file your taxes. That's it. That's the tip. Okay, bonus tip number 2 is to substantiate your tax write-offs. Remember, tax write-offs must be ordinary and necessary for your business, and if you find yourself in a gray area, then you may be able to justify your reasoning with documents and evidence for the need of this business expense for your operation. So what you want to do is keep your bank statements, keep your receipts and your invoices, and keep notes of everything that happens. So in an event that an audit does occur, you can provide some documentation and state your case. And at the very least, the IRS should be able to see your intent and rule out the possibility of any fraud or tax evasion taking place. Okay, I hope all this made sense. If you have any questions, please write them down in the comment section below, and I'll try to get back to you within the first 24 hours of this video publishing. Okay, coming up next, I have 2 more videos to talk about tax deductions and tax strategies, so make sure you check those out if you haven't already, and I'll see you over there.